Hi, welcome back to the final session on investment philosophies. So, in this session, what I'd like to do is gather together everything we've talked about and try to find a path, at least, for you to find your best investment philosophy. The key word is for you to find your best investment philosophy. There is no one investment philosophy that fits all. So, I think the process of finding an investment philosophy should always start with you, because you need to choose an investment philosophy that meets your personal and financial characteristics. And if you pick a philosophy that doesn't do that, my guess is you're going to fail. And that is my explanation for why so many people read so many books on investing and so few people are able to convert what they read in those books into returns on their own portfolios. So let's start with the self-assessment question. Basically, let's look at the personal characteristics that you should find out about yourself before you pick an investment philosophy. Let's start with patience. Are you the kind of person who has a lot of patience, or are you impatient by nature? If you are impatient by nature, then almost by definition, you're not well suited to a long-term investment philosophy. You can tell me that it's the best philosophy, but if you're impatient, you're going to sell far too soon or buy far too soon. So that's the first. Second, be aware of how risk averse you are. You don't have to compute a quantitative risk aversion coefficient. For yourself, see what makes you comfortable. What kind of investments make you uncomfortable? How much risk is too much risk? And answer that question for yourself. It's not even for the next person or for all people, it's for you. Third, are you an individual or a group thinker? Don't jump in too quickly and say, I'm always an individual, because some of us are more susceptible to peer group pressure than others. You say, why should this matter? If you're an individual thinker, you're a much better candidate to be a contrarian. If you're a group thinker, you're a much better player in the momentum game. So whether you're an individual or a group thinker will determine whether you're the momentum strategy or a contrarian strategy. Fourth question, how much time do you have available to spend in investing? If you have a really busy life, you're a doctor, you work 15 hours a day, and you can at the most spend 5 or 10 minutes each day on investing, the kind of philosophy that is right for you will be different than if you are a retired person who's willing to spend 6 hours a day on investing. And finally, talking about retired people, what's your age? An investment philosophy that's right for you at the age of 25 might not be right for you at the age of 55 or 65. So start with this personal inventory, because if you end up with an investment portfolio that doesn't match your particular requirements, you will know. And there are 3 tests that I use to tell me when I've made investments that I shouldn't be making. The first is what I call the sleep test. In other words, you lie awake at night wondering what's in your portfolio and how it's doing. You failed the sleep test. If you picked an investment philosophy you're comfortable with, you should be able to go to bed when you usually go to bed, not think about your investments while you're sleeping, and definitely not while you're doing other things. So if the sleep test basically is a shortcut for saying if what's in your portfolio constantly dominates your thinking, you have a problem. The second is what I call the life change test. If if your investment is exposed to risk and you lose money, do you have to change the way you live the rest of your life? Do you have to, for instance, I've heard people say, well, if the market does badly over the next 6 months, I will have to delay retirement. If that is in fact the case, you have a portfolio that's not right for you. So essentially, if changes in your portfolio can lead to huge life changes, then you've overreached on your portfolio. You're trying to do with your portfolio what it was not meant to do. And thirdly, what I call this the second guessing test. If you constantly second guess what you do, you buy something and you spend the next 6 weeks thinking about what you bought. You sell something and you spend the next 4 weeks thinking about what you've sold. You fail the second guessing test. So these are subjective, gut level tests, but I think every investor needs to put himself or herself through these tests to make sure he or she does not have a philosophy that does not match their requirements or their personality. Secondly, you could look at your financial characteristics. Whether you like it or not, your choice of investment philosophy is going to depend on the financial state of your life. What's your job security? How much do you make? How much funds do you have to invest? What's your tax status? All these things can change over time and your philosophy has to change with them. But what you choose as a philosophy has to reflect those realities. So let's start with job security. When you look at your investment philosophy, there are 2 things related to your job that will play into what kind of philosophy was right for you. First is the level of your earnings. Other things remaining equal, the more earnings you can generate, the freer you get about what you do with your portfolio. You can take more risks with your portfolio. You can choose a philosophy that has a much longer time horizon because your ongoing earnings will cover your expenses. The second factor related to job security is how stable are those earnings. If you're in a job where you could lose if you make a lot of money when you have a job but you lose your job every 3 years, that's going to affect the kind of investment philosophy you pick because it determines your time horizon. So look at job security. Second, look at how much money you have available to invest. If you have only $5,000 to invest, your choices become much narrower. You have $5 million to invest, you have much wider choices. So the more money you have to play with, the more choices you have in terms of what investment philosophy you can adopt. And when you think about how much money you have to invest, don't just think about your savings. Think about your pension fund, your IRAs, your insurance savings accounts. Basically, it's a collective portfolio, and you have to think about moving things around in those portfolios. Now, some of those choices, the pension fund, for instance, you might be restricted in what you can do in terms of the choices you make, but there are more choices now than there used to be. Third, look at your cash needs. Both investors, individual investors, and institutional investors face unpredictable demands for cash. For individuals, it might come from a health problem, from a spouse, from a child needing money for whatever reason. For an institutional investor, it might be a client pulling cash out because they either got impatient or something happened that required them to have the cash. Those unpredictable demands for cash withdrawals can affect what philosophy you pick. So if you have absolutely no demands for cash withdrawals, you have more freedom. You can have a longer time horizon. If you have unpredictable demands that rise and fall, that reduces your time horizon, makes the choice of philosophies much narrower. You also have to consider the probability that this will happen, even if you don't know that. Even if there's no known demand for cash on the table, you have to build in the probabilities that there will be a demand for cash withdrawal somewhere along the way, and that again will affect your investment philosophies. And finally, your tax status matters. Investors who face high tax rates on income will have to pick a philosophy that best captures that. So you want to make sure you don't end up adopting ways of investing that leave you with a huge tax liability. Now, what makes this a messy process is different parts of your portfolio, different portions of your income can all get taxed at different rates. So dividends might be taxed at one rate, capital gains might be taxed at a different rate. The income you generate on your pension fund might not be taxed at all. The income you generate on your savings could be completely taxed. So what philosophy you adopt will reflect what portion of your portfolio you're talking about investing. So we've looked at personal characteristics, we've looked at financial characteristics. The third thing that matters is what kind of beliefs do you have about markets? As we said, every investment philosophy is built on a presumption that markets fail sometimes and that you can take advantage of those market failures. So you have to come to a clearly thought out set of beliefs about how markets work and how they don't work. You're saying, how am I going to come up with that? Well, start collecting information. Every story you read, every discussion you have should feed into that way of thinking about markets. But here's the best way to build up beliefs. As you invest over time, you're going to get lessons from the field. Some good lessons, some bad lessons. You're going to make money, you're going to lose money. And if you're sensible, you will take those money-losing occasions and make them teaching moments where you teach yourself about how markets work. And then the investment philosophy you pick has to reflect what you think about markets, how you think they work, and how you think they fail, and that philosophy has to capture that. So let's look at the choices in terms of investment philosophies. Again, I've tried to take all the philosophies we've talked about in these over the last 37 sessions and put them in here. Your investment philosophy can be short-term, medium-term, or long-term. It can be, broadly speaking, a momentum philosophy, a contrarian philosophy, or what I'm going to call a opportunistic philosophy, where you're not trying to play prices in either direction, you're just looking for opportunities when they pop up. So as an example, under short-term philosophies and short-term momentum philosophies, I have technical momentum rules, relative strength, stocks that have gone up the most. Information trading is a short-term momentum strategy, buying right after positive earnings announcements. Contrarian short-term strategies, you could have contrarian indicators. We use mutual fund cash positions and do the exact opposite. You could also have opportunistic short-term investments where you look for pure arbitrage, two absolutely identical assets trading at different prices in different markets, or even demand indicators. We look at trading volume and we try to gauge what that'll mean in terms of short-term price movements. You can have medium-term philosophies. If you're talking about momentum, you could talk about relative strength over 6 months or a year. You can again have information trading strategies, which are longer term. For instance, you could come in and sell short on IPOs after they've gone public, trying to take advantage of that 3 to 5 year swoon in stock prices you see in these companies. Among medium-term contrarian strategies, you could have market timing strategies where you assume that mean reversion will translate into high PEs dropping back to averages over time. And information trading again can be medium-term contrarian, where you buy after bad news because you think markets overreact. And in terms of medium-term opportunistic strategies, you can have near arbitrage opportunities. Paired trading, for instance, is a good example of a medium-term strategy. And you could have speculative arbitrage opportunities, where you basically buy, merger arbitrage. Essentially, those, under near arbitrage, of course, we're talking about futures and derivatives, where you might have to hold 6 months, 9 months, a year to actually make money on those investments. Finally, you have long-term philosophies that range the spectrum from momentum philosophies, which is what passive growth investing is. You buy stocks with high PE ratios expecting them to keep going up. Passive value investing is actually a contrarian long-term strategy because you're buying high PE stocks expecting the PE to go down. And contrarian value investing, where you buy money-losing companies and you hope they turn around in the next year, the next 2 years, the next 3 years. Finally, under long-term opportunistic strategies, I would classify active growth investing, where you take stakes in, or activist growth investing, where you basically take stakes in small growth companies and essentially nurture them into exit. And activist value investing, where you essentially again buy stocks in poorly managed companies and try to change them. So in a sense, you can see your choices vary both in terms of time horizon and what kind of, whether you want to go the momentum route, the contrarian route, or the opportunistic route. And there are lots of philosophies out there. So you're saying, which one's right for me? There are two ways you can approach this question. One is to try to find the best philosophy, the one philosophy that best fits you. So what might fit you is a contrarian value investing philosophy. Just pick that philosophy and that's all you do. A slightly more complicated and dangerous way of doing this is to find a combination of philosophies that work with you. So for instance, for the most part, you might be a passive value investor, but you might add a momentum strategy on top to try to make more money. But when you mix different philosophies together, here are two things I would like you to keep in mind. If those philosophies make contradictory assumptions about market behavior, don't mix them, because ultimately you have to stay consistent with a way of thinking about markets. And when you try to go against that consistency, you get into trouble. The second is, if you have multiple philosophies, try to pick your dominant philosophy and try to pick your secondary philosophy so you know what's going to drive your decision on the first place. And then you can use the second philosophy to kind of finesse those choices. So in closing, I think the key to successful investing is picking an investment philosophy that's right for you, which basically means to be a successful investor, you have to know yourself. And if you pick a philosophy that doesn't fit you, you're going to find yourself abandoning that philosophy really quickly or not having the returns that match up to what you see on paper. Your choice of philosophy will also be affected by what you think about markets and how investors work or don't work. And also, those beliefs will change based on your experience. It's always good to get feedback from the world. And if your feedback leads you to reassess your philosophy or refine it, I think that's the best way to actually think about investing. Overall, thank you very much for having sat through all these sessions with me. I know we've looked at just the tip of the iceberg, but what I'd like you to start thinking about is the best investment philosophy for you. Take care.